you have a residential property and you're renting it out and you're making money off that property, we want to make sure you're accurately accounting for the depreciation deduction on that rental property, because it's your biggest tax deduction. But a typical tax deduction is when money's exchanged. For the depreciation deduction, no money's actually exchanged. It's calculated on the tax return. And we commonly see this deduction miscalculated, or even worse, the deduction is not even on the tax return. So in order to calculate the depreciation for a rental property, first we have to look at the purchase price of the property. So let's say I purchased a rental property for $1 million. We have to break it down to how much of that $1 million is allocated to the land and how much of that $1 million is allocated to the actual building structure on the property. So let's say from that $1 million property, 40% or $400,000 is allocated to land, and the other 60% or $600,000 is allocated to the actual building structure. That building structure amount, in this example, that $600,000 is what we're really focusing in on. And we can depreciate that building over 27.5 years. So you would take that $600,000 building value and divide it by 27.5, which would equal annual depreciation deduction of just shy of $22,000 per year that we can deduct against our income that this property is producing. We can't do anything with the portion of the property that's allocated to the land. You cannot depreciate land. Let's do a double take on our tax returns. Did we accurately account for the depreciation deduction of our residential rental property? And hopefully this points you in the right direction.